Okay.
Anla, Marie, can y'all hear us?
I can hear.
Okay, awesome. Fantastic. So how's everyone doing this evening?
Fine.
Excellent, excellent. Well, my name is Jeremy McDonald. I'm with Carbon Capital. So I'm a local mortgage broker. I've been doing mortgages now since 2003. So started out at City Mortgage and have been quite a few different places since then. And then Tanise, if you want to introduce yourself.
Hey, how you doing? My name's Tanise. I am a realtor with River City Premier Realty. I've been a realtor for about 8 years now, working with a lot of rental clients for the first few years. And in these last few years, I've been helping a lot of rental clients turn into home buyers. So that's what I'm here for today.
Awesome. Thank you so much. So this evening, just kind of want to go over what we're going to do. There's going to be some slides that we're going to go over and kind of talk about 5 different myths of purchasing a home, and then we've got a few bonus myths. And then at the end of that, we're going to open everything up to a question and answer session. So, to begin. If you want, you can take a snap of that. We're also recording this, so we can send this out to you as well. But that's our contact information there. So 5 myths about buying a home in today's market. So the first myth is that you must have 20% down. And that's definitely not true. There's a lot of different options out there to where that you don't have to have 20%. So a standard FHA mortgage, which is kind of the most common mortgage and the easiest one to qualify for, typically you put down 3.5%. So that's pretty standard. In today's market, you do need about a 620 credit score to be able to qualify, and that's just 3.5% down. If you're looking to purchase in a rural area like Middleburg, Green Cove Springs, Yulee, Baker County, or St. Johns County at 210 or south of that, there's actually a program called a USDA loan. So one of my favorite loan programs to do because it's 100% financing, so you don't have to have a down payment, and the interest rates are really low on it. Kind of the caveat with that program is that if you have a household of less than 5 people, the maximum household income is $82,000. If you have a household of 5 or more, it allows you to go up to $122,000. So really good program. Like doing that one quite a bit. Now, if you are active duty or military veteran, there are VA mortgages, which are also 100% financing. They're also very easy to qualify for veterans as well. If you have just amazing credit and you're a first-time buyer, there is what's called the Home Ready and Home Possible program. Those are conventional programs that only require a 3% down payment, and they also have reduced private mortgage insurance. So you get a really low payment on those. Those would be for clients that have kind of like a 720 or above credit score. With that one as well, there are income restrictions. So each individual can't make more than, I want to say, about $55,000 per year in Duval County. So as well, there are some different down payment assistance programs. Currently, a lot of those have been suspended with the coronavirus and how that's negatively impacted the mortgage industry and our economy. Typically speaking, the most common one would be the Florida Bond Program. So with the Florida bond program, there's a couple variations of that. The first variation is a $7,500 down payment assistance, which comes in the form of a second mortgage that you don't make payments on. Now on that one there, after 5 years, that $7,500 is forgiven and you don't have to pay it back. But prior to the 5 years being up, if you want to refinance or sell your home, you do have to pay that money back. One of the additional things about that program is the interest rates are typically about 1% higher than a normal mortgage. So you do qualify for less and you're going to have a higher payment on the same price home as you would on a regular FHA or conventional mortgage. And then the other thing there is the debt ratios are lower. So you also, it does restrict what you can purchase. Now, the other bond is a second mortgage for 30 years. You don't make any payment on it, but whether you try to refinance in 5 years, 15 years, or 28 years or sell, you have to pay all that money back. So that one really limits the ability for you to take advantage of lower interest rates. And kind of what we're seeing in the market right now and where all the experts are predicting things go is that once we get a couple months out of the coronavirus and things being back to normal, interest rates really should be in the very low threes and even into the mid twos. So right now, yes, if you have perfect credit, you can get really low threes or even into the twos. But once everything settles down, someone with a 640 credit score should be able to get in the really low threes or into the twos. So doing a down payment assistance program would prevent you from being able to refinance into literally the lowest rates in the history of mortgage rates. So that's kind of some of the options there. So myth number 2, you must have a perfect credit score. That is definitely not true. So as I said, right now you do need a 620. Typically in the past with FHA, we could go down to 580, and with VA, we could go down to a 500, and with USDA, we could go down to a 550. But because of concerns with the coronavirus and the impact that the forbearance for all is having, everyone's kind of tightened up their guidelines. So you definitely don't have to have a perfect credit score, but you do need at least a 620. So myth number 3, now is a bad time to buy. Could not be further from the truth. We still do have record low interest rates currently right now. And one of the things that's very interesting, if you look at the past 5 recessions, you see that other than the one in 2008, which was directly caused because of the subprime mortgage market, and the one in 1991 with the Gulf War, the other recessions, we also saw an increase in home values after those. So January and February were record months in appreciation. Appreciation was up about 5.5% year over year. So that's a trend where they've actually released March data now, where March is still up in the appreciation of the values, even though the number of homes being sold is lower. So definitely a good time. And if you look at the .com and the 9/11 crashes, although the S&P 500 went down dramatically, you didn't see the home values go down. They actually did go up. So not really the correlation to the market that we have then or today. So when you look at Goldman Sachs, they've released their forecast for the gross domestic profit, which is the total amount of money that's spent in the economy. So Q1 was doing really well until March came around. So it did end up on a 6% loss or less, and Q2 is expected to be at about 24% less. But as you see, Q3 and Q4 of this year are set to be higher. And what that's going to do, when you look at the Wells Fargo Investment Institute, they don't expect that we're going to see the recession that we saw in 2008 and 9, because this is from a virus, and the oil shocks are not an endemic on the financial system, but are rather they're external factors. So Saudi Arabia decided to flood the market with oil when they knew that everybody was staying at home. So it was a calculated move that they did on purpose, not an indication of the actual economy. So once the virus and infection rate peaks and we go to recovery and we get into where the economy is completely opened back up, the final quarter of this year and especially into 2021, everything looks very, very strong. So myth number 4, you should purchase a home at the top end of your pre-approval. I will say that not only is that a really bad myth, but that's a scary myth. It doesn't really make sense to stretch yourself out to the absolute max purchasing a home. Now, by all means, I have a fiduciary duty, so if that's what you want to do, you can do it. But it's not the best way to build for the future. And the reason that I say that is as a homeowner, you're going to have additional expenses. Like if your water heater goes out, you do have to replace that.
Yep.
I know Denise would do a great job and get you a home warranty, but that is a realistic fact. Also, a lot of people, when they purchase a new home, they want to get new furniture, and that's also a very common time for people to upgrade their automobile. So you're adding additional expenses onto your budget. So if you purchase at the very top of your pre-approval and you don't have any margin in your budget, and then you're adding additional expenses, you're just risking going into a bad position. So what I really recommend doing, instead of looking at, hey, I want to spend this much on a house, what is the payment that I will feel comfortable with? And then I can back it in from what the payment is that you feel comfortable with and let you know, okay, well then with that payment, this is the price range that you want to be. That way you're feeling comfortable in the home that you have. So myth number 5, it's cheaper to buy a fixer-upper. Now, that does hold true if you are a general contractor, because if you're a general contractor, you can do all the work yourself, and you can do a renovation loan and also do all the work yourself. So when you're watching the home flipping shows on TLC or HGTV, Love the Property, Brothers Love Flip and Flop, those are really cool shows, but they're not really realistic. So when you're talking about buying a fixer-upper that is going to be a home that you're going to live in, there's a couple different mortgage programs that allow you to finance in renovations. One of the requirements with that is that all the work has to be done by a licensed general contractor that's approved with the Department of HUD. So I'll go ahead and say those contractors are very busy. Not only are they very busy, they are not discount contractors. You will pay a premium for having them do the work on your home. So you might think that you're getting a good deal on a fixer-upper and fixing it up in that manner, but you're going to pay a premium on having that work done. So as cool as renovation loans are, there's only a handful of situations where they really make sense. Now, what does work out is if you find a home that's a little bit older home that hasn't been updated in 15, 20 years, and it's stuff that you can then do yourself or hire someone to do after you purchase the home, but it's in good move-in ready shape. You just want to update things. And if that's something that you want to do, there's really good companies like Lightstream that do renovation loans that aren't an actual mortgage, and you could do maybe a 5-year term, take out $10,000, replace the floors, repaint the house, new light fixtures, whatever it is you want to do. So there is a way to do that that does make sense without you having to break the bank by paying a licensed general contractor. So those are the 5 most common myths in home buying. Now, just like the abominable snowman, Yeti, Bigfoot, whatever you want to call them, there are more myths. So we've got 3 more of those. So the first of those is that banks and credit unions are the best for first-time buyers. Having been in the mortgage industry since 2003, that's kind of a funny one for me. And I say that because when you look at a loan officer for a bank or a credit union, they typically do auto loans, home equity lines of credit, overdraft protection loans, personal loans, and most of them were a teller not too long ago. So they're truly not an expert in the mortgage industry. They also work banker hours, and you're going to contact them through the bank's phone. My business account is with Bank of America, which is literally in front of my office, and they drive me insane because they close at 4 o'clock. So I couldn't imagine buying a home and having a mortgage loan officer that I can only speak to from 9 till 4, Monday through Friday. I mean, what if you're looking at a home of an evening or a weekend and you need to put in an offer and you want to make sure that you qualify for the home? In addition to that, banks and credit unions are going to be the most restrictive and the hardest to qualify for, and they don't have the best interest rates either. As a mortgage broker like myself, I have access to over 122 different lenders, which some are banks and credit unions, that I can take your loan through. So I always am going to be able to make sure that you're getting the best interest rate possible and you're not limited to just one credit union or one bank. So that's definitely a myth that a lot of people think. And then once I talk to them and we kind of compare their options, they see there's a difference. On top of that, my work cell phone is on me 24 hours a day, 7 days a week. I have a home office in addition to my physical office off of Bay Meadows. So if you need me, you have my cell phone, you can get in contact with me. So bonus myth number 2, it's cheaper to rent than own. Definitely not true. And I know Denise works with a lot of renters as well and first-time buyers that are coming out of renting. So, you know, historically speaking, 25.8% of your income is needed to afford median rent. And only 21% is needed to afford the median home. However, today in 2020, you need 28.4% of your income to rent compared to only 17.5% to own. So it's definitely more affordable to own. In addition to that, 5 years or 10 years worth of renting and you have nothing to show. You've not done anything to create wealth for you or for your family or for your children. After 5 years or 10 years or 15 years of owning your own home, you've built up equity in your home by the appreciation and value and the paying down of your mortgage. So it actually is an investment for the future. So bonus myth number 3, you cannot buy a home if you have student loan debt. So that is definitely a myth. Student loans can make things more difficult, especially if you've got $100,000 in student loans. So FHA treats student loans where if they're in deferment or income-based repayments, the way that they treat those is whatever the total cumulative balance of your student loans, we have to take a 1% of that balance and use it as a payment. So that can be a high amount. So it can affect how much you can purchase. If you're going with a VA mortgage through the VA, it's a little bit easier because it's a 5% of the total amount of student loans, and then we divide that by 12, so that is less. Now, what's really cool is with Fannie Mae, they give us the option to, if you are in an income-based repayment program, to where that we can use that income-based payment. And if your payment ends up being, whether it's $5, 5 cents, $0, or $50, we can use that payment. So if you're in a situation where you went to school, you acquired a very large amount of student loan debt, and you're not at a point in your career to where that you're making enough money to offset that, that's a good program. Now that program, you do need about a 680 credit score to qualify for that, and you can't have any late payments or collections in the past 2 years. So that is one that you might have a little bit of work to do if that's your situation. So there's definitely options there. So that's our 5 myths and the bonus myths. So now we're going to kind of open things up. So if anybody has any questions for Denise or myself, we would love to answer those. You can either unmute yourself if you're muted and just ask, or you can type it in the group chat.
I have a question.
Okay.
What if your credit score is going up but you have collections? Are you still going to have to clear out the collections?
It depends. So do you know where your credit score is at currently?
Yes, 571.
Okay. So in today's market, you do need to be at a 620. Now with the collections that you do have, what type of collections are they? Are any of them medical collections?
Yes, some are medical, some are retail credit cards.
Okay, so with your medical collections, those actually don't count against you. I mean, they do affect your credit score, but we look at those as not even being there. And the reason being is because it's very common in the medical field to where that if the insurance company doesn't pay the invoiced amount, they just throw it on your credit for collections, which is actually illegal. So there's been pending legislation with Congress literally for years to make it illegal to report medical collections to your credit. But unfortunately, we have a bunch of politicians that don't like to get things done. So that's still not done for whatever reason. But yeah, it doesn't affect your score. Now with the credit cards, it's possible. Are they more than 24 months old? So did they go into collections more than 2 years ago?
Yes, I think so. Yes.
So those are definitely not going to have to be paid off. Again, they do still have an impact on your credit, but if it's more than 24 months old, there's really, I mean, we're not going to have to count a payment towards your debt ratio, and it's not going to disqualify you from getting a mortgage if you have those. And what's kind of interesting with that is if you were to pay a collection account that was 5 years old, it's going to update and show as a paid collection, and it's going to update for this month. It's actually going to hurt your credit. It's an admission of guilt, and it's taking an account that's old and aged and bringing it up into the present. So you'll actually see your credit score drop if you pay it off or pay it at all.
Yeah, this group that I'm on Facebook, some people said they've done that has happened. They've seen their score drop after paying it off.
Yeah. Yeah, I mean, the best thing to do is to get your credit cards to a limit to where that, you know, if you have $1,000 credit limit, that it's under 10%. So that's kind of the magic number. And I've heard different people say 7% is the magic number. Others say 3% is the magic number. But I know when I've seen it and I do my credit simulator program, that whether it's at 10%, 7%, 3%, 1%, it's all the same. It has the same impact from what I see. So, I mean, if you have any credit cards, paying down the balances will definitely help. You know, if the collections are more than 2 years old, you do have, you know, the possibility to try to get those collections removed. So have you disputed any of those?
No, not yet. Been putting it off.
Okay. I mean, if you do enough homework, that is something that you can do yourself.
So I've heard.
However, I mean, there are certain credit people that are really good at that. And, you know, I mean, sometimes you look at it and say, okay, is it worth me paying someone $250 for them to get this removed from my credit, or me having to spend the time and the frustration of researching websites, making sure I'm sending the right letter out, following up on it the right way, and doing all this. So it does kind of become an issue of convenience versus cost. And if you need a credit person, I do have a couple of them that do a really good job.
Yeah, it is. I have an issue with paying that kind of money out of pocket.
Yeah.
Yeah.
Yeah, man, I definitely understand. And I have been seeing on Facebook an ad for like a do-it-yourself credit repair. I don't know how that works, but I mean, you definitely can yourself. So, I mean, if you're at a 571 and it's going up,
it's going up.
Other than paying down credit card balances, the next thing would be to try to get some of those accounts removed. I mean, one of the things that some people do is they will reach out to the collection agencies and say, hey, I'll pay it, but you have to completely remove it from my credit. I don't want it as a paid collection. It needs to be just absolutely removed. And I mean, I have heard of instances where some collection agencies will be willing to do that.
Also, it's best to get it removed.
Yes.
Than to just show that it's paid.
Yes. Yeah. Because if you're showing
even if I'm making payments on it.
Yeah, because if you're doing that, you're admitting guilt.
And mortgage companies.
Well, it's not mortgage companies, it's Experian, Equifax, and TransUnion.
I was going to say the mortgage company doesn't like, you know, they see that as guilt, or the credit bureau?
No, it's Experian, Equifax, and TransUnion. It's updating your account to a newer status. So if it was a 3-year-old collection and now it's one that you're making payments on, they're going to update the balance each month. So you're going to be having, essentially, it's almost like getting a new collection every single month. And because you are paying on it, the way that Experian, TransUnion, Equifax look at that is that you are saying, I failed to pay this obligation. I am admitting that I was wrong, that I should have paid it, and I did not pay it. I was irresponsible. So although you're paying it now and you are trying to be responsible, it's kind of like the innocent until proven guilty. If you don't pay it, they're like, oh, well, maybe it's a mistake.
Maybe, yeah.
But you start,
wow.
Oh, well, we know that you did something wrong here, so we're going to hit you worse for it because we know that you actually were wrong. It doesn't make any sense at all, but
that's how they see it. Well, thank you for that tip.
Years, that's one of the things where I'm just like, man, this does not make any sense.
Well, the reason I'm looking to, I've been skeptical all my grown life to purchase, but I'm tired of renting. Now, I want to know, I just turned 50 this year. Am I too late in the game to get in the home buying game?
Not at all.
Absolutely not.
I've heard that, but I just wanted to hear it from a professional.
No, I mean, it's actually kind of interesting because I have one client who, she's 87 years old. And, you know, like when I was talking to her, she's like, I want to make sure, Jeremy, she's like, I want to do a 30-year mortgage. And I'm like, okay, that's fine.
At 87?
Yeah, she's 87. She's like, now, you know I'm 87, right? And I'm like, yeah. She's like, you know I'm not going to live 30 years, right? And I'm like, well, I mean, who knows, but probably not.
I'm glad she said it.
And she's like, but I mean, you can't tell me no, right? And I'm like, absolutely, that would be discrimination. I'm like, I cannot tell you no. If you want a 30-year mortgage, you have every right, just like anyone else, to get a 30-year mortgage. And she's like, my kids are so ungrateful. She's like, I don't care about leaving them in the equity or whatever. She's like, give me the 30-year mortgage. So, okay. It's against the law to discriminate based on age. Can't do it. So if she wants a 30-year mortgage, she's getting a 30-year mortgage.
Wow.
Yep.
Okay.
So needless to say, no, you're not too late in the game.
Now, you didn't have it in the myths. I don't know if it's a myth or if it's just comparison. A single family home versus a condo.
So, this is my personal opinion. I avoid condos like the plague.
I don't want to deal with a lawn.
So this is and this is why I say that. So from a finance standpoint, condo associations are really horrible about keeping their approved status with whether it's FHA or Fannie Mae or Freddie Mac. So what happens is when they're brand new, they keep everything up to date so that you can get whatever type of mortgage that you want. But then 6 years later, now all of a sudden all their approvals have expired and there has to be a new condo approval, you know, for basically each person that's buying a home. And with that, FHA won't approve every condo. Neither will Fannie Mae and Freddie Mac, which of course are more difficult to get qualified for. And one of the things that a lot of people don't talk about is that if you do a conventional mortgage, you go through the condo approval process, which typically most property management companies will require you to pay a fee for them to fill out all the paperwork. So sometimes that fee is like $300 or $400. So whether or not they get approved and you buy that home or not, that's still a fee that you're going to have to pay. But what could happen is there could be too many rentals in there. They could have a deficit in their budget that's too great. They could have too many people delinquent on their condo association dues. And then instead of, all right, well, we had you approved for a conventional home ready 3% down. Now, because of we can't issue a full approval for that condo association, you're required to put 15% down. And you don't know that until you go through the condo approval process. So, and then in addition to that, you have your condo association fees. So if you were to buy like a $140,000 condo and it's got $300 a month association fees, that would have been like buying a $200,000 house. Your payment would be the same amount. So kind of the way that I look at that is, if you don't like doing yard work, I don't like doing yard work. I have a guy, he comes every other week. It's $40. He trims my hedges too. So, okay, $80 a month, and I don't ever have to do any yard work. I'm cool with that. That's better than that's better than a condo association fee for me. And I mean,
well, in addition to what, Jeremy is saying, just, I've managed a lot of condos and I've managed a lot of single family homes. And, the plumbing issues in condos it's just ridiculous. Plumbing is an expensive repair. And with the condos, a lot of the condos share the same main plumbing line. So let's say your neighbor upstairs is doing construction on his condo and he's throwing debris and things down his toilet or down his sink. It's suddenly getting into your condo. And let's say you're the bottom, you're the downstairs condo. Your condo is going to be the one that's going to flood from him putting those things in his sink upstairs. Now you're having to pay for it. You're having to fight with him about it. It's a scenario that you really don't want to get into as an owner. As a renter, it's not so bad, but as an owner, you want to stay away from things where there's going to be a lot of problems, like plumbing, maybe electrical, not so much with condos electrical, but plumbing, major issue. Yeah. And with the lawn, there's other, ways, like Jeremy said, if you don't want to get somebody to cut the grass, you can, if you don't, like, let's say you find something that's not in an HOA, you can put stone down, you can put whatever kind of, lawn down if you, prefer
pavers
to,
or have it cemented.
Yeah, exactly.
With some fake
and with
flowers.
houses, you have so many options. What's that?
I say with some fake flowers outside.
Okay, exactly. You don't have to water them.
Old school.
Hey, I saw some at a store the other day. I couldn't believe it. I was like, are these fake?
There you
really?
go.
That's something to think about.
Instead of a condo would be going with a townhome. So townhome, their association fees are normally more along the $125, $150 a month. So if you were buying that $140,000 condo, now you're buying $165,000, $170,000 townhome. So you still get the benefits of the association is going to do the upkeep on the outside, so you don't have to worry about that. But now you're typically going to have a garage, and there's no condo approval process. We treat those just like we would treat a home that is in a community that has a homeowners association. So what side of town do you stay on?
I'm in Orange Park.
Okay. So, you think of a community like in Oakleaf. So Oakleaf, every single community has homeowners association fees. Whether it's a townhome or a regular detached home, from a mortgage standpoint, it's the same thing for us. The homeowners association fees are the only thing different. So I always encourage someone that's looking for a condo, if you don't want to get a regular house and just have someone come cut your grass, townhomes are great. You're also typically going to have the same amenities with townhomes that you're going to have with a condo. So most of them are going to have, a pool, they're going to have a clubhouse and those things. Really, the only time that I ever recommend condos is if someone's looking to buy a condo on the beach or like in downtown and they're $500,000 and up, because that's a completely different scenario.
Gotcha. I was thinking about, I kind of consider the townhouse the only, I'm trying to get away from people. The only thing is that most townhomes, they're, wait, say that again?
I said a condo would be the worst thing possible if you're trying to get away from people.
It would, but my mind was the townhouses, aren't they all connected?
Yes.
To each other?
Yes. Yep. Now, I mean, you can
and
always
then would I be able to choose I don't want to hear kids.
So townhouses are 2 stories. So
Right.
the only noise you would hear would be next to you. And I mean, I guess it depends on the age of the home. If it's an older built townhouse, you're not going to hear anything. So
Okay.
I mean, I would just say, like, you need a regular house that's not in a homeowners association, and that way you don't have to worry about your neighbors.
mhm.
Now, where's your job at? What side of town?
Down the street from where I live. I'm on Wells.
Perfect.
Yeah, I'm on Wells.
Okay,
So
so
you should look into, if you're trying to get away from people out into Green Cove area.
yeah, I mean, because Green Cove is USDA eligible, so that is 100% financing. And what's nice
Oh.
about that is they have a guarantee fee, which is similar to FHA's mortgage insurance, but it's less than half the amount. So in addition to it's 100% financing, the guarantee fee is less. The interest rates are basically the same. So in a USDA, you're actually going to pay less money for the exact same house on a USDA mortgage with no down payment as you would on an FHA mortgage paying 3.5% down. So, I mean, if Green Cove is an option, I mean, there's Middleburg too, but if those are options.
Which is now, I don't think I've been to Green Cove. Which is closer to town, Green Cove or Middleburg?
Green Cove.
They're
Green
probably
Cove.
about the same distance, I would say.
Well,
Do you get to Green Cove
down 17?
going down San Jose?
No, down 17.
Green Cove is down 17. So,
Okay.
like if you're on Wells and you take a right on 17, you'll go through Fleming Island, and then right past Fleming Island is Green Cove.
Oh, okay. I went that way once. Okay.
Yeah, it's probably about a 15 to 20 minute drive with traffic from, the middle of Green Cove to Wells.
Mm-hmm.
Yeah, and 17 traffic is not good. It's definitely bad. I used to live in Fleming Island, but compared to Blanding traffic, yeah, a 17 would be better.
I work right down the street.
Yeah.
So I mean, not even a mile down the street. So I do not, for the last year or two, no traffic. I know.
You've gotten used to that luxury living.
Yes. I'm looking to move right now because my lease is almost up where I am, and I'm trying to stay somewhere close. Somewhere close till I'm ready to buy.
Yeah.
Because I used to work in Mandarin. I used to have to cross the Buckman.
Ooh.
Yeah. So working on Wells and living on Wells, it's been a breeze. I must say. And yeah. I'm spoiled.
Green Cove.
Yeah.
Yeah, Green Cove.
Green Cove.
I mean, in between Wells and Kingsley, there are quite a few properties, in there that are not in any type of community with a homeowners association, and you can get, they've got some nice, values as well.
Mm-hmm.
Yeah.
Mm-hmm. Now with the USDA, what your credit score has? What does your credit score have to be?
So right now, really, with anything, it's a 620, and it's technically speaking, there's still options down to a 580, but they're really not. So what we've seen is what's called a bunch of overlays come out from lenders, where they're saying, all right, we've added these additional underwriting conditions, whether it's raising our credit scores up or lowering debt ratios or whatever. So there's a few lenders that they technically have not raised their overlays from a 580, but like when I try to go in and get a quote on interest rates and what's called price things out, anything under a 620, they have what's called a discount fee to get any interest rate, even the highest interest rate that's on what's called the rate sheet. And the discount is so obscenely high that even if you wanted to pay for it, I couldn't get the loan to pass what's called high price mortgage loan, which is illegal. You can't do those. So they've basically just played around with their pricing to say, we're going to make it literally impossible for you to do a mortgage under 620 without technically coming out and saying, oh, here's new overlays where our new minimum credit score is a 620. Like, it doesn't even make sense to me. Like, I saw one where someone had a 599 credit score, and I'm like, all right, well, the scenario ran. Okay, I looked at it. They were trying to buy a $200,000 house. They would have had to pay a $22,000 discount fee at closing to get the highest interest rate, which is illegal. It's against the law. You can't do it. So that's why I say it's really 620, because I can price a loan with a 620 and you can come to closing with normal closing costs. Yeah. But anything below that, it's crazy.
Yeah, I was getting kind of excited when you said it earlier. I'm like, oh, I'm almost there. Since I'm at 571. But my score has been going up. Sometimes it'd be 4 points, sometimes it's 7 points. Recently, the last raise, the last time it went up, I think was like by 17 points.
Okay.
Nice. Keep working at it.
Yes.
So are you paying
now that
down on credit cards?
No. I have a loan, and then I'm paying my car note. And I wanted to ask about that, but I'm paying my car note on time.
Okay. Do you have any credit cards right now?
No, because I'm just awful with them.
So by not having a credit card, you're missing out in, I want to say something along the lines of 60 points on your score. So my advice would be to, who do you bank with?
VyStar.
Okay. Me too. And I have such a love-hate relationship with them. I had one of their accounts when I was in high school. I've been with them since they were 16. And I literally yesterday was on the phone with them and I'm like, you guys are seriously going to make me just move all my money over to Bank of America because y'all have all these additional stupid rules. Okay.
I thought it was just me.
No. Love, hate. Like, car loans are fantastic. Their credit cards are fantastic. But dealing with them makes you want to pull your hair out. And I guess I've already pulled all mine. So,
that's who my car loan is through.
Yeah. And they're good for that. So what I would recommend is go to Google and type in Capital One secured credit card. And so you can
I don't like the word secured.
I know. Think of it as a
just savings. Give it to me. Tell it to me.
I would just do one for like $200. They'll send you a credit card. You will have to do a deposit. Now, they do tier it. So they could come back and say, we need $50 from you, or they could say, we need $200 from you. But then they'll send you.
Okay.
And then what you want to do, if it's $200, don't put more than $20 on it. And then when the bill comes due, make sure that you pay it. You want to make sure it does have a balance. So like $1, $2, $5, whatever. But just make sure that it doesn't go above $20. That way, no matter what time of the month it is that it reports, you're going to have less than 10% of that available credit used, which is going to give you the maximum benefit. So if you're at a 570, I mean, it's theoretical that if you open that up, like let's say tomorrow, I mean, it's theoretically possible that you could be right around that 620 mark, you know, in 30 to 45 days once that credit card reports. And then with your rent, are you on the lease? Is the lease in your name?
Yes.
Okay. So there's a company that I work with, and this is one where you really have to be tricky because I see this advertised on Facebook, get your rental history added to your credit. Most of those, they just add it to your consumer credit reports, which like when we pull a mortgage credit report and I see somebody that's used one of those companies, it does not impact us. Like it's literally like factored out of that credit score. But there is a company that they can add it to TransUnion and I think Equifax, an up to a 24-month history. So it costs $250. It takes 10 days for them to add it on there, but that's then giving you a 24-month history on an installment loan, that you're getting a whole 24-month history on it. So between those two things, there's a very good likelihood that if you did both of those, that would get your score, up above the 620 that you would need, and that you would be able to buy, and definitely buy before. When did you say your lease expires?
July.
Okay. So July 30th?
The 22nd, it's up.
Okay. So, I mean, it would be cutting it tight, but if you did that, especially the secured credit card, like let's say you did the secured credit card tomorrow, then that means that by the end of June, that's going to report on your credit at the latest. And I mean, you could even wait until the beginning of June to do the rental history, because that only takes up to 10 days. A lot of times it's less than that. So by the time that credit card is reporting on your credit, the rental history would already be reporting on it. So, I mean, it would give a tight window, and maybe you could extend, your rent for a couple weeks or a month or so. But I mean, they're definitely, I mean, it would be tight, but that is something that if you did act quickly, especially with that credit card, that it is possible that you would be able to purchase in time.
Interesting. Because some people, it be months before they go to closing. I mean, I don't know exactly how many months, but look like a long time before they go to closing. And then I don't even know exactly what that means and how long that process takes.
Yeah, I mean, for us, typically it's a 30-day contract. So if Denise was to go out, help you find the perfect home, you get that house under contract, it would be a 30-day contract. Now, if we do a USDA mortgage, after we get a clear to close, we do have to send it to USDA, which it can take them 3 days, it could take them 5 days. So on those, we do like a 45-day contract. But for a regular FHA or conventional mortgage, 30 days is plenty of time. We normally have those ready to close at least about a week early. Now, when you're talking about dealing with credit unions and banks, I know a lot of them right now are running 2 to 3 to even 4 months on their approval timeframe. So if you're hearing that from, friends or people on social media, it's probably because that's what they did.
Oh, okay.
So you ready to buy a house?
I'm getting almost.
Almost.
I'm still nervous about it, about the whole thing, because I've been renting since my early 20s.
Change is scary sometimes.
It is. Oh, I know.
If you think about it, I mean, it's definitely the best change that you can make. You're setting a future for yourself. You're leaving a foundation for your kids, your kids' kids, and everybody who comes after you. And it is scary for sure to think about spending that amount of money, getting under those kind of contracts, and putting that kind of responsibility on yourself. But the benefits far outweigh the fear. You know what I mean?
Right.
Think about it. You can have your own whatever kind of dog you want, for instance. That's one thing that is for me, because I'm an animal person. So that's what I hate about rentals. You can't have whatever kind of animal you want, and
they have restrictions.
Exactly.
Sure,
And you want to make it, put in updates, make your house look exactly the way you want. You can't do that with rentals. You can't go and put in a ceiling fan without having to ask somebody. So there's it's freedom. It's freedom to be able to cross over that line of renting into home ownership.
Right.
So it's scary, but you'll be fine.
With that, with all of that, I have another question.
Sure.
I'm not from here. I'm from Louisiana.
Nice.
And the job market is not looking great for me in New Orleans. So I decided to stay and buy a home. here in Florida. I miss home. But if at some point I decide to move back,
you either A, have Tenise sell your home, or you B, have Tenise rent your home out.
Yep.
so do I have to be in it for a long period of time?
Technically speaking,
I'm like I told you, I'm 50 now. Say I do decide to retire at the normal age of 65, and decide to move back. I've been in it 15 years.
yeah, I mean, the two things are you're signing an affidavit at closing stating that you do plan to occupy this home within 30 days as your primary residence. FHA likes to see that you've lived there for at least a year before renting it out. But even if you lived there for 3 months and rented it out or sold it, I mean, there's nothing that could be done. There's no penalty that you could incur. Yeah.
Okay.
So there's ways out. If you buy a house, you're investing, into your future. And if you decide to leave, we can help you with that. Whether you sell it, take out your equity, or you rent it out and let somebody else pay for your home.
Mm-hmm.
Absolutely.
Yeah, I think I will sell it.
I see that you're still on. Do you have any questions, Marie?
No, I'm good. I don't know if you can hear me.
Barely.
She's real low.
I don't have any questions. I'm just sitting on the side, just taking everything in.
Okay. Sounds good.
I'm getting excited.
You getting excited?
So are you going to go get
a
your card?
That's one of the scary parts.
It's your own money. You're basically just using your own money to build your own credit. So it's not, it's like Jeremy's racing back. So it's not too bad. It's not too
Right. Yeah. I'm gonna have to look at the terms and conditions, because I have it and I don't have it.
Mm-hmm.
The required amount to open up a secured card.
Okay.
I have it and I don't have it. My car is at the mechanics. That's the beauty of living on Wells and working on Wells.
Okay.
I could walk to work, or I've been taking the shuttle. But anywho, so I'm waiting to hear from the mechanic on the car, repairing my car.
There's another way. If you have a family member or a friend that has a credit card that has a good payment history, and a low balance and a low payment, you can ask them if they would be willing to add you on as an authorized user. So by doing that, you would get all the benefits of the length of time, the payment history, and the ratios of that credit available to credit used. So that's something that we kind of advise a lot for people that either have just made a choice to stay away from credit cards, or especially with younger people that just don't really have credit history.
Mm-hmm.
I mean, like I have my oldest daughter, she's 22, she's in the Air Force. She's stationed up in Grand Forks, North Dakota. And we were talking a couple of weeks ago, she hates it up there, but she's got to be there for 3 more years. And I'm like, well, why not buy a house? And I'm like, better yet, buy a duplex up there. And then when you get out and you come back home, just rent that thing out. And I'm like, I'll add you on to a couple credit cards. You'll have a really great credit score. Boom, there you go.
Yeah, my sister did that for her daughter, who's 22 now.
So maybe ask your sister if she wouldn't mind putting you on one.
Oh, me and my sister, we fell out.
Oh, okay.
Oh.
Oh, yeah.
Tell her that she owes you one real quick.
I could, because she started it.
Yeah. Like, look,
started the best.
we'll be cool if you could just put me on there real quick as authorized user.
Like, I don't even need the card. You can have the card.
Okay.
I don't even need it.
But you know, with that, I have both my brothers. They I might consider asking one of them.
Yeah.
I have one here and I have one in Louisiana, and it's just to add me as an authorized user.
Correct.
Nothing else. I don't.
Correct.
Gotcha.
I mean, and you can tell them, hey, just have the card sent to your house, and you can feel free to cut it up.
Right. I don't need the card.
Yep, I ain't trying to use it. I just
Yeah.
but you do want to make
I just
sure
need the
that-
credit boost.
Yeah, you want to make sure that it's one that they have not had any late payments on, and that their balance is very low.
Oh, the brother. I don't know how about his balance, but the brother here. Oh yes, he pays his. Yeah. Okay.
Because I've seen a couple times where someone was like, "Oh, I got added onto my parents' credit card that has a $10,000 balance on it with a $300 a month payment." Oh, now you're also responsible for that $300 a month payment on your debt ratio. So you went from being able to buy this house to be able to buy this house.
Gotcha. So, with a low balance and a great payment history. Looked
Yes.
like I had another question with that. Okay. Dang, the question keep coming and going away.
It happens to me all the time.
Oh, it's not coming back. It might come back after we're off of this live.
You got our information right
If
here.
you want to do a
Oh, you're right. And
of-
I've been making notes, so I'll write the question down if I do.
Yeah,
remember.
if you want to do a screenshot of Denise and mine contact information from that slide there, or write it down. I mean, again, I have this cell phone on me all the time, so I have it on Do Not Disturb from 10 o'clock at night until 8 o'clock in the morning. But other than that,
Right.
I'm available.
I've reached out to Denise before. I was looking to rent.
I thought your name looked familiar.
Yeah. I reached out to you a couple of times looking to rent.
So we talked on, was it on Facebook or did you call me? I'm trying to think.
Yes, Facebook Messenger. Messenger.
Okay. Oh yeah. I get flooded with Facebook messages.
That definitely can happen.
Well, I can't think of anything else.
Okay. Well, if you do.
Now this session, you said you're recording it,
Yes.
and you're gonna share it with me, or
Yeah, I mean, what we were planning on doing is just posting it on Facebook with the link. So it's going to be
okay.
to a Google Drive. So it would just be
Okay.
an HTML link so that you could literally save it, download it, whatever you want to do with it.
Okay. Yes.
I mean, with our contact information, anytime you have any questions, you're ready to do anything, just let us know. I also do soft credit pools with Experian. It is a mortgage credit score, but it does not affect your credit at all. So that's a great way to get started as well, to kind of see, because if you're doing credit monitoring on like Credit Karma, they use Advantage scoring model, which is very, very different from a mortgage score. So it's good to have that. So, I mean, that's also something that I can do for you.
I have another question, if I can ask.
Sure.
I don't know if it's considered a myth, but if you're trying to buy a house, it's not good to have a newly purchased vehicle.
Yeah, I mean, it's a new account being opened, so new accounts, depending on your overall credit picture, like if you don't have accounts, a new account's fine because the benefit outweighs the negative. If you've got multiple, installment loans, and then you go get a new installment loan like a car loan, it is going to take a few months for it to have a benefit for you, and the beginning you will kind of lose. The other thing I would say with that is if you're, if you get a new car, if you're replacing an old car with a new car and the payment is the same or less, cool. If it's more, wait until you buy the house. Or if you're adding a car payment that you don't currently have and you're not replacing the car payment, then let's wait till you get closed on the house. I had a guy that was buying a $750 some odd thousand new construction home who decided right before closing that he was going to buy a $200,000 boat.
Oh.
So, needless to say, he was not able to buy that house. But he got a $200,000 boat.
Live on the boat.
Okay.
I couldn't even believe it. And this, Denise, this was new construction. This was a custom built home. So I mean, this thing was under construction for more than 10 months. And it's
he couldn't just wait. He couldn't wait just a couple more months.
no.
Good Lord.
Yep.
They were building it for him or just building it and he decided he wanted to buy it?
They were building it for him. It was a builder. So it was in a community. So, I mean, they were building it on their lot, but it was a custom builder. So, I mean, it wasn't like, D.R. Horton or KB Homes where like you can make a couple changes. It was
right.
You really truly can play around with the floor plan. So, I mean, it was a site built, home. It wasn't a spec home that was already built.
Right.
Yeah.
Wow.
Yeah.
He couldn't take the boat back. I don't know how all of this goes. He couldn't take the boat back?
No, he could not take the boat back, and he took about $50,000 in assets out and put down when he bought it, so he didn't have enough assets remaining to put down to offset having a payment on a $150,000 loan for a boat. So I'm fairly certain his wife and children were not happy with him.
Wow.
I don't think the boat was like, oh, it's okay, but we got a boat.
Man.
I'm sure the builder was really upset because it's not every day you sell a custom $750,000 home. Like, okay.
No.
Well, I guess we're going to go ahead and end the call. So it does take a little while for it to convert into a uploadable format. But we'll get the post out either later this evening or tomorrow. So if you do have any questions at all, please definitely feel free to reach out.
Okay. Thank you. This has been informative.
I'm glad that you've enjoyed it.
Yes.
So,
and now I have some homework to do.
Absolutely. And we look forward to helping you in the future. So have a good evening.
Thank you. You have a good evening as well, both of you. And Marie.
Coming. What's that?
I was saying have a good evening to Marie also.
Oh.
All right. Well, I'm going to go ahead and log us off now.
All righty. Thank you. Have a good night.